Before you sign the closing papers on your dream home, you are presented with a stack of documents nearly 2 inches thick. Most people spend weeks researching the neighborhood, hours looking at the kitchen photos, and days worrying about the property taxes. But when it comes to the most important document in the entire stack, the one that actually determines their financial freedom for the next 3 decades, they spend less than 10 seconds looking at it. That document is the closing disclosure. And the one number that most people glance over is the total interest cost. In the United States, we are conditioned to shop for a monthly payment. We ask ourselves, can I afford $2,800 a month? If the answer is yes, we feel a sense of victory. We celebrate. We take photos with the sold sign. But what if I told you that by focusing exclusively on that monthly payment, you are walking blindfolded into a $1 million trap? The banks don't sell you a house. They sell you a debt product. The house is just the bait. Today, we are going to do the math that the lenders hope you never perform. I'm going to show you exactly how to calculate the total interest on your mortgage before you even make an offer. We are going to expose how a $450,000 house can easily cost you over $1.3 million by the time you're done. Welcome back to the mortgage trap. Grab a calculator, a notebook, and some coffee. This isn't just a video, it's an audit of your future. 1. The psychology of the monthly affordability trap. The entire real estate and lending industry is designed to keep you focused on the now. Lenders, real estate agents, and even sellers all want to know one thing: what is your monthly budget? When you focus on the monthly payment, you lose sight of the total cost of capital. This is a psychological trick known as framing. If I tell you that a loan will cost you $600,000 in interest, you will run away. But if I tell you it's only $2,700 a month, it feels manageable. It feels like a utility bill. But a mortgage is not a utility bill. It is a 30-year commitment to transfer your future labor to a financial institution. When you look at a $450,000 home, you aren't seeing the true price tag. The system relies on your inability to perceive the weight of 360 consecutive payments. Most Americans spend more time researching the specs of a $1,000 iPhone than they do calculating the $600,000 interest on their home. Today, we break that cycle. 2. The auditor's formula. Calculating the real price. Before you visit a single open house or talk to a realtor, you must run this calculation. It is the only way to see the real price of the property. The banks are legally required to show you this on the Truth in Lending disclosure, but they hide it at the very bottom in small print. Let's perform a real-world audit. Imagine you're buying a house for $500,000. You put 10% down, $50,000. So your loan amount is $450,000. At a 7% interest rate, your monthly principal and interest payment is $2,993. To find the truth, follow these 4 steps. Step 1. The total outflow. Take your monthly payment, $2,993, and multiply it by 360 months, the length of a 30-year loan. $2,993 times 360 equals $1,077,480. Step 2. The interest extraction. Subtract the original amount you borrowed, $450,000, from that total outflow. $1,077,480 minus $450,000 equals $627,480. Step 3. The percentage audit. Divide the total interest by the original loan. $627,480 divided by $450,000 equals 1.39. The shocking result: you're paying 139% of the house price just in interest. You're buying one house for yourself, and you're buying nearly 1.5 houses for the bank. When you see the total interest of $627,480, you realize that you aren't just paying for a home. You are paying for the bank's CEO's private jet, the bank's marketing budget, and their shareholders' dividends. All of it comes out of your 40-hour work week. 3. The amortization engine. Why the first 120 months are a scam. Lenders often tell you, don't worry, you'll probably sell or refinance in 7 years anyway. They say this to make the total interest cost feel irrelevant. But this is actually where the math becomes even more predatory. Mortgages in the United States use an amortization schedule. This is a mathematical engine designed to ensure the bank gets paid first and you get the house last. Let's look at the first month of that $450,000 loan at 7%. Your payment is $2,993. $2,625 goes straight to interest. Only $368 goes to your principal. Audit point. In month 1, over 87% of your payment is pure profit for the bank. If you stay in that house for 7 years, which is the American average, you will have made 84 payments totaling $251,412. You might think you've paid off a significant portion of your $450,000 loan. But let's look at the balance. After 7 years and $250,000 spent, your balance is still roughly $410,000. You've spent $251,000 to reduce your debt by only $40,000. The remaining $211,000 was simply rent paid to the bank. This is why they love refinances and frequent moves. Every time you reset the clock, you go back to the top of the amortization schedule where the bank's profit margin is the highest. 4. The sensitivity of 1%, the small number with massive weight. In the mortgage world, people often think a 1% difference in interest rates is just a minor detail or market fluctuation. Lenders will say, it's only a 1% difference, it's just the cost of doing business. Let's audit that 1%. On our $450,000 loan at 6%, your total interest over 30 years is $521,000. At 7%, that total interest jumps to $627,000. At 8%, it skyrockets to $738,000. That 1% gap between 7% and 8% costs you an additional $111,000. Think about what $111,000 represents. It's 2 years of a median household income. It's a college education for 2 children. It's a decade of retirement savings. And yet, many people don't shop around for a better rate because they don't realize that one small percent is actually a 6-figure financial catastrophe. 5. The full picture audit, escrow, PMI, and maintenance. When we calculate total interest, we are still being conservative. To understand the true total cost of ownership, TTCO, we have to look at the hidden drains. Property taxes. In many states, taxes are 1.5% to 2% of the home value. Over 30 years, assuming the value rises, you could easily pay $300,000 in taxes. Insurance. With rising premiums, a $2,000 a year policy will cost you $60,000 over the term, and that's if it never increases. PMI, private mortgage insurance. If you put less than 20% down, you're paying for insurance that only protects the bank. That's another $100 to $300 a month that builds zero equity. Maintenance. The 1% rule suggests you'll spend 1% of the home value annually on repairs. On a $500,000 home, that's $5,000 a year, or $150,000 over 30 years. Now, let's add it up. Principal, $450,000. Total interest, $627,000. Taxes and insurance, $360,000. Maintenance, $150,000. The grand total, $1,587,000. Your $500,000 dream home has a real-world price tag of $1.58 million. If you aren't calculating this before you buy, you aren't investing. You are gambling with your life's work. 6. Opportunity cost, the wealth you killed. This is the hardest part of the audit to hear. We must discuss opportunity cost. If you took the $627,000 that you're giving to the bank in interest and instead invested it in a simple S&P 500 index fund over those 30 years, what would it be worth? Even if you didn't invest the whole lump sum, even if you just invested the difference between a 15-year and a 30-year mortgage payment, the numbers are staggering. By choosing the 30-year low monthly payment trap, you aren't just losing the interest. You're losing the compounded growth that money could have generated for your family. The bank is taking your interest and investing it to build their wealth. They are using your money to become your master. 7. How to kill the interest. The counterattack. Now that we've exposed the trap, let's talk about how to destroy it. You don't have to be a victim of the amortization schedule. You can use math as a weapon to fight back. Strategy A. The 15-year pivot. A 15-year mortgage usually has a lower interest rate. More importantly, the math of amortization is forced to move twice as fast. You might pay $3,800 a month instead of $2,900, but you will save nearly $400,000 in interest. If you can't afford the 15-year payment, you likely can't afford that specific house. Strategy B. The early principal. Strike. Interest is calculated based on the current balance. Every dollar you pay above your minimum in the first 5 years has a massive deleveraging effect. An extra $500 a month in the first few years can shave a decade off your loan. Strategy C. Bi-weekly payments. By paying half your mortgage every 2 weeks, you end up making 26 half payments, which equals 13 full payments a year. That one extra payment per year, applied directly to principal, can knock 6 to 8 years off a 30-year loan without you ever feeling the pinch. 8. The final audit. Is the house worth it? At the end of the day, a house is a place to live. It's where you raise your family. It has emotional value that math can't always capture. But you must go into the deal with your eyes wide open. Do not let a real estate agent tell you it's a great investment without showing you the total interest calculation. Do not let a lender tell you you're pre-approved for $600,000. Without calculating the $800,000 in interest that comes with it, you are the auditor of your own life. The banks have their spreadsheets, you must have yours. Before you sign that 30-year contract, look at the total interest and ask yourself, is this house worth 3 decades of my freedom? Because that is exactly what is on the line. Conclusion: breaking the chains. The American housing market is a complex machine designed to extract wealth from the middle class and concentrate it in the financial sector. The 30-year mortgage is the primary tool used for this extraction. But once you know how to calculate the total interest, once you see the $1 million price tag for what it really is, the machine loses its power over you. You stop being a consumer and you start being a strategist. If this deep dive audit helped you see the housing market differently, like this video to help us beat the algorithm and warn others. Subscribe to The Mortgage Trap for more investigations into the mechanics of debt. Don't sign until you calculate. Don't buy until you audit. Break the trap and build real wealth. I'll see you in the next investigation.